Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. The Fed is unlikely to hike the policy rate again in the near future. Importantly, however, the Fed is not likely to cut rates next year, i.e. higher for longer, but that doesn't matter necessarily. Remember 1993, 94, it was higher for longer. The Federal Reserve only cut rates very, very slowly, and that wasn't enough to prevent the S&P 500 from roaring ahead over the next 6 years. With easing supply side factors and base effects primed to push year-over-year core inflation down further, the Fed will not face any obvious policy heat from inflation in the near term. In conclusion, they say that the Fed has not ruled out additional policy tightening in this cycle, but the bar for another rate hike is fairly high. It is safe to assume that the Fed is done with hiking at least for a while. So that is very good news for the markets. So on asset allocation, Alpine Macro, we have been underweight stocks since mid-July, but have increased bond allocation to benchmark a week ago when bond yields were 4.9%. Today, and this was written on the 6th of November, today we are ready to bring up equity exposure to benchmark allocation. In other words, we are back to the 60-40 split between stocks and bonds. For equity allocation, we continue to overweight US equities. So let's move now to the US 10-year Treasury bond, which has caused headaches for fund managers and probably less so for central banks. As we read earlier, a high bond yield helps to restrict credit flow and economic activity. But anyway, this is specifically to look at the structural factors versus the cyclical factors. There has been no sudden loss of confidence in treasuries. In fact, it has been just the opposite, as higher yields are attracting foreign investors. The US dollar has strengthened on the back of record high flows of foreign capital into US securities, including treasuries. The bid to cover ratio at 10-year treasury auctions has been relatively stable, signaling that there is no widespread buyer's strike. The 10-year yield curve has plenty of downside potential once the economic tailwinds supporting growth begin to fade. The conclusion in respect of term premia, there are some structural elements behind the recent bear steepening, but cyclical factors are probably the main drivers. We expect the bear steepening to end once the economic tailwinds fade and the economy finally succumbs to elevated borrowing costs and tight lending standards. So that's good. Moving on to cross-border capital, they've been concerned about these rising 10-year yields and the effect on global liquidity, but it's not just according to the absolute level of the 10-year yield that they measure the effect on global liquidity. It's also the volatility of those bond yields. So they look specifically at the Merrill Lynch option volatility estimate, the MOVE index, for volatility measures of the US Treasury market. And that volatility has been declining. The MOVE index has dropped back to 119 from a recent high of 141, and an October average of 130. As a result, global liquidity conditions are stabilizing. Interesting just to look at where the risk appetite indices are currently. It's often a useful contrarian measure. The best time frequently to get invested in a new market or to open up a new investment is when investor sentiment is very, very weak. So they've got an investor sentiment index that ranges from -50, most negative or pessimistic, to +50, most optimistic. The global risk appetite index is at +30, so it's more or less at neutral levels. It's very high in Japan, +50, and still reasonably high in the US, but not frightening at all at +18. The Eurozone -3, UK -4, and China -30. So there is definitely an opportunity building up in China, possibly, maybe not immediately, but something to keep a close watch on. People's Bank of China liquidity injections have soared in recent weeks, according to latest liquidity expansion data. So central bank liquidity is growing in China at a 30% 3-month annualized rate. That is massive. The People's Bank of China has switched its focus from supporting the currency to supporting the economy. Has China turned a corner? So this leads into the last segment of today's presentation. Alpine Macro, incredibly insightful observations and analysis on China, both short-term, medium-term, and long-term. The good news is that Beijing is finally opening the fiscal tap to help growth. At the same time, we have deeply depressed valuations. The economy is gradually stabilizing and improving. Credit numbers have accelerated, albeit slightly, which is consistent with a gradual improvement in the business cycle. Industrial profits have been improving, along with easing deflation in producer prices, and profit growth has turned positive in more recent months. This could be a crucial factor for boosting business confidence and may help rescue the slump in private sector capital spending. Earnings of listed companies are also set to accelerate. Inventory destocking in the corporate sector has become advanced, and a restocking cycle is likely to unfold. Beijing has continued to step up easing measures, even though its 5% GDP growth target for the year appears well within reach. Policy stimulus. Beijing has allowed local governments to issue about 1 trillion yuan in refinancing bonds. And quite unusual, the central government has approved an additional 1 trillion yuan of special central government treasury bonds to support local infrastructure development. That's the equivalent of 0.8% of GDP. And now the real problem, housing. Will it ever bottom? Not for the moment. The housing sector remains in a deep slump. Housing transactions have continued to contract, even compared to last year's depressed levels. Home prices have continued to fall, and real estate investments have kept contracting, the biggest drag on this year's GDP figures. The economy will not stage a strong recovery without improvement in the real estate market. However, there's always a however, it is also important to maintain a proper perspective. We believe China's housing crisis has nothing to do with demographic factors, as many argue. in comparison to Japan's experience in the last 2 decades. Rather, it is a man-made disaster due to credit crunches imposed on developers. Housing demand has likely significantly undershot the underlying long-term trend, and pent-up demand has likely already begun to accumulate. Remember, China still has a long way to go before it is fully urbanized. In our view, it is not a question of if, but when the housing sector will bounce back. Chinese stocks have become exceptionally cheap by historical standards, evidenced not only by the deeply depressed valuation indicators, but also by the record high levels of share buybacks from listed Chinese firms. We anticipate upgrading our view on Chinese stocks beyond the next several months.
Hi, Nick. Yes, thank you very much for the very interesting and comprehensive macro overview. MTN, they got a heavy fine of 1.4 billion rand from Nigeria. It's a tax fine, and the price, MTN's price dropped a lot. Of course, MTN will fight it. Just earlier this year, they also had a big fine from Uganda, and that fine was dropped totally. And we can just hope that this one will also be dropped in part or wholly, totally. And then another thing from MTN, Fitch rating agencies, they reported that MTN is very well positioned to disrupt the South African remittance market through its fintech platform Momo. So there's something positive from MTN. Another company that made that announced results was for the third quarter this year, Anheuser-Busch InBev. They announced the results, interim results. Revenue increased by 5% in the third quarter, which is I think is very good. And the underlying earnings per share was up from 84 cents to 86 cents. That's quarter on quarter and year on year. Eskom, they recorded a loss of 24 billion rand. It's the biggest loss ever. And believe it or not, they're working now on a new logo, which is going to cost a few million rand as well. A few statistics. The PPI figures came out. The PPI figures is a producer price index. And that is prices at the farm gate or at the factory gate that will later influence inflation figures. The PPI is up in September from 4.3% the previous month to just over 5%. It's 5.1%. It's up, but it is still relatively low. And then the money supply figures came out, the M3 money supply. The previous month it was up 8.53%. This month it was up, or September then it was up 7.65%. And the private sector credit extension, that was 4.39 in August, and in September it was 4.6%. That's positive there.